We are currently looking at Nu Holdings Ltd, trading under the ticker symbol NU on the New York Stock Exchange, closing the recent session at exactly $16.70 per share. The market is currently closed, but the last active trading session left us with a significant downward move, showing a decline of $0.95, which translates to a sharp drop of 5.38% for the day. When you see a red candle of that magnitude on a stock that has been a darling of the fintech world, it forces you to stop and pay attention. This isn't just a minor fluctuation. A move exceeding 5% in a single session for a company with this level of capitalization signals a serious shift in sentiment, at least in the short term. The expectation from the retail crowd, perhaps even from you, is that a company backed by Berkshire Hathaway and posting triple-digit growth metrics should be immune to gravity. You expect it to behave like a compounding savings account, just steadily ticking upward. The reality, however, is that Nu Holdings is currently caught in a violent tug-of-war between its undeniable growth trajectory and the harsh gravity of valuation concerns. While the expectation is that this is just a bank in Latin America, the reality is that it trades with the volatility of Tesla stock and the growth expectations of Nvidia stock, creating a disconnect that can be terrifying for the unprepared, but lucrative for the strategic. Let's break down exactly what is happening with this price action. When a stock like Nu drops over 5% in a day, especially after hovering near all-time highs recently, it usually isn't about a broken business model, it is about a valuation reset. Investors who rode the wave up are deciding to cash out, locking in their gains rather than risking them on the next earnings report. It is the classic sell the news phenomenon, even if the news is simply that the stock price got ahead of itself. You have to understand the psychology here. We are seeing a market that is increasingly jittery about high-growth names that trade at a premium. When you look at online investing platforms today, the average retail trader is becoming smarter, quicker to take profits, and less willing to hold through a drawdown. This creates these air pockets where the price just slips because there are no buyers at the $17 mark. But here's the contrarian take that challenges the fear. This drop might actually be the healthiest thing to happen to the chart in months. Parabolic moves up are unsustainable. A pullback to the $16 range allows the moving averages to catch up and gives institutional investors, the big whales, a chance to accumulate shares without chasing the price. Now, let's widen the lens and talk about what this company actually is, because the misconception is that Nu is just a digital bank app. If you treat it like a traditional bank, you will never understand the valuation. Traditional banks are heavy, slow, and expensive to run. They have branches, vaults, and thousands of employees managing paperwork. Nu is a technology company that happens to sell financial products. Their cost to serve a customer is a fraction of what a legacy bank in Brazil pays. This efficiency is what allows them to offer low-fee products while still maintaining margins that make American banks jealous. Think about how you use Fidelity Investments or Fidelity Brokerage Services. You expect a certain level of reliability, but you also likely deal with a legacy interface or a system that feels built on older rails. Nu started from scratch on the cloud. They don't have the technical debt that a Fidelity Wealth Management division might have to navigate. This agility allows them to roll out updates, credit scoring models, and new features weekly, not yearly. The comparison to U.S. fintech often misses the nuance of the Latin American market. In the U.S., if you want investment help, you have endless options. You can go to Schwab Intelligent Portfolios for a robo-advisor experience, or you can use Robinhood stock trading if you want to be active and mobile first. The market is saturated. In Brazil, Mexico, and Colombia, Nu isn't just competing with apps, they're competing with cash and the mattress. They are bringing people into the financial system who have never had a credit card before. This is why their active customer numbers are so critical. When they report over 100 million customers, those aren't just dormant accounts. These are people using Nu for their daily coffee, their electricity bills, and their savings. The stickiness of the ecosystem is more comparable to the Apple ecosystem than it is to a typical bank. Once you start using their purple card, you tend to move your entire financial life there because the legacy options are so painful to deal with. However, we need to address the elephant in the room regarding the recent sell-off, the expansion risk. Nu has conquered Brazil. They are the kings of the hill there. But to justify the stock price, they need to win Mexico and Colombia. The market is terrified that Mexico will be a cash incinerator. Expanding into a new country means massive marketing spend, higher default rates as you learn the credit behavior of a new population, and regulatory hurdles. The recent drop in the stock price reflects a fear that the profitability in Brazil is being used to subsidize a war in Mexico that might take years to win. When you look at SoFi Invest or SoFi Investing in the US, you see how hard it is to pivot from one product, like student loans, to a full-service bank. It takes massive capital. Nu is trying to do this across borders. They are offering high-yield savings accounts in Mexico to attract deposits, sometimes offering yields of 15% or more. This is expensive. It eats into the net interest margin. Investors look at that and worry, are they growing too fast? This brings us to the competitive landscape. You have to realize that while Nu is unique in Latin America, the pressure from global players is real. You have interactive brokers trading platforms offering global access to sophisticated investors in the region. You have local competitors waking up and improving their apps. But Nu's secret weapon has always been its brand. In a region where banks are hated, literally hated for high fees and terrible service, Nu is loved. People wear Nu branded gear. That type of loyalty is intangible on a balance sheet, but essential for long-term survival. It lowers the customer acquisition cost. While a platform like Robinhood App or Robinhood Crypto has to spend heavily on ads to get a new user to sign up, Nu often gets users through word of mouth. One person gets the purple card, loves the lack of fees, and tells their entire family. This viral coefficient is the holy grail of investing sites and fintech models. It is what allows them to keep their marketing budget relatively low while still adding millions of users per quarter. Let's discuss the Cajinas, or money boxes feature, which is their version of automated savings. It is similar in spirit to Schwab Intelligent Portfolios or the SoFi Robo-Advisor concept, where the goal is to make saving effortless. By allowing users to segregate their funds for specific goals, like a vacation or a new car, Nu locks in the deposits. These deposits are the fuel for their lending engine. A bank needs cheap deposits to lend out at higher rates. If Nu can get millions of Mexicans to deposit their paychecks into these boxes, their cost of funding drops and their margins expand. This is the thesis. The risk, of course, is that if the economy in Mexico sours or if inflation runs rampant, those deposits could flee, or the loans they issue could go bad. The NPL ratio is the metric you must watch like a hawk. If NPLs start ticking up faster than revenue, the stock will get crushed. We also need to talk about the Buffett seal of approval. Berkshire Hathaway investing in a fintech stock was a shock to many. Buffett usually likes simple businesses with moats, like Coca-Cola or, well, Apple stock. But his team saw something in Nu, a moat built on data. Nu has more data on Brazilian consumers than perhaps the government does. They know who pays their bills on time, who spends where, and who is a credit risk. This data advantage allows them to price credit better than the legacy banks. In the world of self-investing, we often look for companies that have an unfair advantage. Nu's data engine is that advantage. It is not just about a pretty app interface, it is about the algorithm underneath that decides who gets a $500 limit and who gets $5,000. I want you to take a moment and think about your own portfolio. Are you holding fintechs? Are you exposed to emerging markets? Comment below how many shares of Nu Holdings or any other fintech like SoFi stocks or Robinhood fractional shares you currently hold. Do you think the growth in Mexico is worth the risk, or are you staying on the sidelines? I really want to see the consensus in the comment section because retail sentiment often leads the institutional moves in stocks like this. Moving back to the technicals and the reality of the stock performance. The drop today to 1670 is testing a support zone. If it breaks lower, we could see a flush down to the $15 level, which would be a massive buying opportunity for long-term holders. But if it holds here, it validates the bull case that this is just a pause. You have to remember that online investing sentiment is fickle. A stock can go from hero to zero in the eyes of social media traders in a week, but the institutional volume, the big block trades, tells a different story. They have been net buyers over the last few quarters. They are looking at the return on equity.